So I've made a lot of videos on this channel now that talk about the business cycle, but I haven't exactly defined what the business cycle is. And I think the business cycle is one of those things that a lot of people say, but not everyone necessarily knows what it means. So in this video, we're going to do the business cycle for dummies. Basically, just a high level overview of the business cycle. We'll go through the 4 phases, the different economic data implications of each of the phases, and then how you can think about potentially investing across the business cycle. Before we get started, I am Ryan Hartung, and I'm a member of the Macro Institute. You can see a link to our website in the description of this video. We have a professional designation program, a newsletter. We offer a ton of stuff, so check that out and engage with us. Okay, so this is what you might have seen before when it comes to the business cycle. This typical sort of looks like a normal distribution arc. And we break down the business cycle in 4 phases. We actually label these a little differently in our practice, which I will talk about later in the video. But what is the business cycle? I have a definition here on the bottom right. The business cycle is simply the natural rise and fall of economic growth over time. So we've labeled here the 4 phases. We have phase 1, expansion. That is when economic growth, or in this case, what we describe as LEIs, which I've talked about in previous videos, and I'll talk about on the next slide. When they're recovering from a contraction, then we have phase 2, the peak. That's when LEIs are expanding and they eventually hit their peak. We have phase 3, the recession. That's when LEIs start to decelerate. And then number 4, we have the trough. That's when LEIs are contracting and eventually bottom out in anticipation of going through it again and starting with phase 1, the expansion. So it's a repeatable process over and over and over again. Again, this is the textbook business cycle. I will show why later that this is not always what happens in reality. So same thing here, except showing you a list of the leading economic index, or the LEIs. I've gone over these in previous videos, but this is sort of what these are the different types of series that you could be tracking along the business cycle. We use the ISM index mostly for our work here. So let's go through phase by phase and what you can typically expect for major economic indicators during each of the 4 phases. So again, typically expect over real cycles in the economy. Not everything you see listed here will work out exactly like it does in a textbook. But again, these are the general expectations. So we start with phase 1, the expansion phase. That is when economic growth is positive and generally accelerating. So you have the ISM, it's starting to rise. The unemployment rate starts to fall. So it was at a high point, presumably, during the trough. And again, we'll get to the trough. And now it's starting to fall. Inflation is generally low, but during the end of this phase, you'll start to see inflation start to rise again. Interest rates are low because, again, generally speaking, the Fed has just cut rates in response to a recession or a contraction. So right now, as we start to recover, interest rates are low. Consumer confidence is strong at this point and starting to rise. So this is generally where we see the trough of consumer confidence. So consumers are starting to get more comfortable. They're starting to spend more money during this period. Again, interest rates are low. Wage growth and business investment are rising. Again, wage growth generally, with inflation, as inflation starts to rise, you'll see wage growth start to rise and business investment rising. Why is that? Interest rates are low. That's part of the reason why the Fed cuts interest rates to get them to this point. So economic growth can recover. And one of the ways that happens is through business investment. That brings us to phase 2, the peak phase. So what's happened now? The ISM has continued to accelerate to this point, typically, and it is now nearing its peak. The unemployment rate will hit its lowest point, again, generally, during this phase. Inflation is rising and at some point will peak. Interest rates are rising generally as economic growth picks up and inflation picks up. The Fed will generally start to hike rates to avoid the economy overheating. Consumer confidence is very high. Wage growth is incredibly strong. And business investment is growing, but a bit more slowly than before as interest rates have started to rise. And that brings us to phase 3, the recession phase. That is when economic growth generally turns negative. So the ISM index is beginning to decline. The unemployment rate is probably starting to rise at this point off of its lows. Inflation has peaked. So generally, you have interest rates stabilizing at this point. So you might see inflation start to come down a little bit, if not at least stabilized. So this is generally where you'll see a Fed pause, right? And there's a lot of questions. Are we about to go into a downturn? Are we going to find some sort of soft landing? So interest rates are generally stable here. Consumer confidence is eroding. Wage growth often stagnates. Wage growth very rarely contracts. I'm sure you can find times in history where it has, but in general, it will just slow. And then business investment at this point starts to contract given the high interest rates. And that brings us to phase 4, the trough. So this is where a lot of the stuff hits its highest or its lowest points. So the ISM will hit its lowest points. The unemployment rate will hit its highest point. Inflation, lowest point. Interest rates at this point are declining because the Fed is cutting rates in reaction to the recession phase. Consumer confidence is pretty low. Wage growth is very weak. Again, it's not generally doesn't contract, but it'll be very, very weak at this point. And business investment starts to stabilize as the Fed is cutting rates. So I'm going to stop a second here and suggest you screenshot this slide or this table. Basically all it is, I'm not going to go through it. I combined the mini tables from the last 4 slides so you can see what to generally expect from key economic indicators during each period of the business cycle. So again, I'll pause here, take a screenshot. Good thing to have next to you. Okay, so I mentioned we think about the business cycle a little bit differently than the 4 phases. We think about it almost in 3 phases. We have the risk on, which you can think of as combining the expansion and the peak. And during this period, you can see the S&P 500 in the last 9 business cycles is up 8 out of 9 times. Average return 30%. Risk off, which is similar to the recession phase. You can see it's about a 50-50. S&P 500, it's been up 4 times, average return slightly negative. And then during the risk aversion phase, or as the economy's troughing, you can see horrible returns, only positive 1 time, negative 20%. So you might be looking at this, sorry, I hit my mic there. You might be looking at this and say, well, investing across the business cycle is easy, right? I just need to buy stocks right before the risk on phase. I need to sell stocks somewhere in the risk off phase, right? The returns aren't great. So, I'm holding or potentially selling, but I'm not adding to my position. And as long as I sell my equities before the risk aversion phase, or if I reduce my holdings, then I'll be all right. Well, it's not as easy as it looks. And this is why. What I showed you was the textbook business cycle example where you get 1, 2, 3, 4. We show an example here on the left with the ISM New Orders Index. Again, this was generally pretty standard. However, what sometimes happens is you get a lot of mid-cycle slowdowns that aren't necessarily a turn in the cycle, right? So you might be expecting to hit the economic contraction, but it was really a head fake. It was just a mid-cycle slowdown, and then you see a reacceleration before you get to real lows, an eventual slowdown. So the risk here is, during the midst of a mid-cycle slowdown, you mistake that for the recession phase or for the risk-off phase, is what we would call it. But in reality, it was just a small pause in the expansion phase. The other thing that makes this complicated is that you need to be picking sectors or names that perform well during these specific periods. Now, I've blocked out the sectors that we normally have this labeled. but you can see sort of some of the factors that do well at different phases. And you can see there's a lot of overlap. So if you were to get this wrong and you were to exit your cyclicals and your value names for stability and growth because you were expecting a recession or to enter the third phase, but in reality, it was just a head fake, you're going to be caught off guard and your returns could suffer. Now, unfortunately, I don't have time here to teach you guys how to figure out the difference between a head fake or a true turn in the cycle. We have a lot of content that covers that. There are ways to uncover that. And we have strategies for investing across the business cycle. Again, I don't have the time to show you in this video. However, I do have two options for you. Number one, we are doing this summer, July 16th, what I like to call a macro workshop for new hires. Now, it's branded for new hires because we partner with companies to train their interns. However, this is open for everyone, and I think it is at the level that most people could benefit. So it's a crash course in macroeconomic investing techniques. We have real-world case studies, and some of the things that we talked about today, sort of how to master the business cycle, how to invest across the business cycle. We cover the basics in an event like that. So I'm going to put the link to register for this event in the description of this video. Half-day event, highly suggest you check it out. It's virtual. You will learn a ton. Option number two is our full professional designation. As you'll see on the next slide, when my name bar appears with my professional designations, I'm a CFA charter holder. I also have my MSD. They're both fantastic designations, and we cover the business cycle. I think professional designations are really important. I'm obviously biased. I have two of them, and I work for a company that offers one. But what you see here on the right is the chapters for level one. And it really all comes down to learning the data, how to interpret the data, and then making investment decisions around the business cycle. So if you are looking to master the business cycle, I highly suggest you check out our professional designation. And here's what we'll do for you. If you reach out to me and you've signed up for this event, our macro workshop for new hires or summer interns, and you enjoy it and you want to pursue the professional designation, we will knock that cost of the event off of your fee for signing up for level one. So all you gotta do is reach out to me. My email is at the beginning of this video, and I believe it might also be at the end, I'm not sure. But you can find my email, reach out to me on LinkedIn, just get in touch with me, and we will reduce the cost if you attend to this event and enjoy. So I'm going to leave you here. My email is not on this slide, but you can see our website and reach out to us via that link. I'm going to leave you here with this today. I hope you enjoyed this video, an introduction to the business cycle. It takes a lot of work to master the business cycle. It's a really difficult concept. Investing across the business cycle can add some alpha, but it is hard to learn. So interact with us if you want to learn more. We have a professional designation. We do events. Don't hesitate to reach out. And the very least you could do is subscribe to the channel. All right. Hope you guys have a great weekend, and I will talk to you guys soon.